So today's presentation, I think my thought was that I'll take that perspective, the perspective of an investor, the perspective of a fund manager, perspective of somebody who's trying to decide whether they should invest in your business or not, and what are the questions they would like you to answer. So if you're presenting to a potential, even a potential partner, potential employee, there are a couple of common questions that are linked to modeling, not linked to modeling in a financial modeling sense, but linked to modeling in a thinking sense. And my hope and my objective is that at least in the first half of today's exercise, we'll walk through this model and this framework. And if we have enough time, then we'll take maybe one or two examples from the room and work the same model through for those specific examples. A simplistic way of looking at this is that if you have 6 ideas in your head, how do you decide which idea is worthwhile? So these could be product variations, these could be customer segments, these could be market opportunities, these could be possible paths that you could explore with respect to future pivots. How do you know which one is a better path? How do you score? How do you gauge? How do you decide how to get there? So when it comes to valuation, you have 2 primary frameworks that you can work with. One is your conventional approach. And the conventional approach is a great approach. It starts with a very sequential mindset. And that mindset starts with building a financial model. So most of you have done some variation of this. Then you go out and evaluate free cash flows, and those free cash flows can be converted into trying to figure out what your return on investment is going to be, what your return on investment capital would be, your IRR or your net present value, right? So this is your conventional finance focused traditional approach, and we've all gone through this. The challenge and the problem here is that when you use this approach and when you use this model, you've got a framework that is reliant on a lot of assumptions. And when you put that model in front of me as an investor or a partner, there's a fair bit of diligence that I have to do. So what I'm really looking for is a shortcut approach, an approach that allows me to cut through all the layers of the model and focus on the central theme. And the central theme brings me to what I call the customer-centric approach. The customer-centric approach says that I want to do a high-level calculation to see whether the model holds, whether the model would work. And in that high-level calculation, my first question is, how much is a customer worth? So that gets me to what I call a customer valuation model. The customer valuation model essentially is a fancy name for what we call lifetime value of a customer. If you compare the 2 approaches, your conventional approach starts with year 1 and goes to, let's say, year 10. And it says, year 1 our free cash flows are going to be X, and year 10 our free cash flows are going to be Y. And the difference between these 2 is essentially an indication of the value that we've created. A customer-centric approach uses a very similar model, but rather than looking at free cash flows, it says, here's the lifetime value of my customers, and here's my current book of customers. So let's say I have 100 customers here right now, and let's say my lifetime value is about 1,000. So this venture should ideally be worth 100 into 1,000, so about $100,000. But at the end of 10 years, I'll have 1 million customers. And at the end of 10 years, with these 1 million customers, my lifetime value is going to be about $10,000 per customer. So it's not just that my customer book has grown, but my LTV has also grown. And this customer book into lifetime value is an indication of the value that I can create over a period of time. So that's the 2 approaches side by side. Here, this is FCF, free cash flow focused and centered, and this one is focused on lifetime value. For example, if I want to disrupt the life insurance industry in Pakistan, I can take a look at how much is the insurance industry worth using a conventional approach. And that conventional approach has a shortcut method, and that method is called the book value method or the multiple method. So I take the book value of the industry and I have a valuation multiple that I use as an investor, and that gives me a sense. So for example, if the book value of the industry is 1 billion and the multiple is, let's say, 2 times book, the industry is worth about $2 billion. If I want to look at an alternate metric, for example, premiums, I might say that the industry premium is about $1 billion and the multiple is about, let's say, half, so 0.5. So the industry is worth about 500 million, right? These are both approaches that come from the conventional financial valuation model side, and they're similar, they're analogous to what you see on the FCA side. The only difference is that rather than building a complete model, we simply go out and build a shortcut, and that shortcut says I've got X value for a metric, I multiply that value by a valuation multiple that is acceptable, that is appropriate at that point in time, and I take it from there. So that's two. The non-conventional, the customer-centric approach would be how many potential customers do we have, what's their LTV, current customers time LTV, and that gives me an estimate for the valuation number for that industry. So if I look at the life insurance industry, my metrics are very simple, right? My metrics are on the conventional side, and we're talking about Pakistan as of 2021. Life insurance industry as of 2021, end of 2021, had a book value of about $140 million. And had premiums of about $1.2 billion, earnings of about $40 million. And these are public figures, right? And this is the entire industry. So if you looked at these measures and these metrics, how much do you think the insurance industry would be worth? Remember, we're not looking at one specific entity, we're actually looking at the entire industry. And this perspective is also very important for a couple of reasons that we'll touch upon right towards the end of this class. So when I say book value is what? Book value is the book value of shareholders' equity. So the book value of shareholders' equity of all the insurance companies in the Pakistani market as of 2021 was 140 million. If I give you, let's say, a multiple of 2 or 3, how much do you think the industry is worth? You would simply multiply this 140 by 2 and 3, right? This would be 280 if you use 2, and let's say about maybe 420 if you use 3. Again, similarly, if I use premiums, let's say the right multiple for premiums is, let's say, 0.2. If the right multiple for premium, valuation multiple for premiums is 0.2, then the industry is worth how much? 1.2 into 0.2, which would give you about, let's say, about maybe 240 million. You see a trend? If I say earnings multiple is worth about 10, then it's going to be 40 million into 10, right? And that is about $400 million. Now, why are we spending time on this framework? Because when you speak to me about a industry, when you speak to about disrupting or changing or modifying or capturing market share, how much market share could you capture in one go? You could at max, and this is conventional thinking, you would at max capture, say, about 100% market share. And if you captured 100% market share, your maximum valuation would be the numbers you've just identified. So one common mistake that we make when we start presenting our numbers is that we build the models and we grow them, and we grow them to a point where we are about 3, 5, 10 times bigger than the current industry. And maybe there is a version, maybe there is a edition of the universe in which you can get to that point in time. But for most startups to predict or to forecast or to suggest that they will have a valuation which is going to be multiples of the current valuation for the entire industry is basically something that I call uncredible. You damage your credibility by making claims like these. And for that specific reason, it's important for you to understand, if you're disrupting a specific industry, what is that industry worth right now? It's good context. It's good context for the conversation. Rather than saying I'm going to build X and that X is going to own and wipe out this industry in the next 10 years, it's useful to start by saying this is what the industry is worth today. And when I disrupt it, this is where it's going to be. And my vector of disruption, the mode, the path, the trajectory, the route I'm going to use to disrupt this industry is going to rely on these specific drivers. And because of these specific drivers, the industry is going to grow, right? So that's one specific element. Apply this or extend this framework, right? What we're saying is, on a book value basis, the industry is worth 300 million. On a premium basis, worth 300 million. Earnings basis, worth 316 million. How do I disrupt it? What choices do I have? And here we come back again to the LTV framework. The LTV framework says that on the retail side, for the insurance industry, you're likely to get about 5 to 10 million customers. If you assume that you retain a full 100% of them, you are saying that the industry is worth about, say, 300 million. And if I take 10 million customers, the lifetime value of each customer is about $300. If I take 5 million customers, the lifetime value of each customer is about $600. So now my question to you is, this is a quick frame of reference and check. If I asked you to disrupt the life insurance industry, what are your possible vectors of attack? Let's assume the insurance industry right now has 4 million unique customers, and your maximum, let's say, size of the Pakistani middle class in terms of household, that's about 15 million households. So if you assume one policy per household, the insurance industry has 4 million unique policies. At max, it can get to about 100% of that market share, and that would be about 15 million households. So one vector of attack is you come out and say, I'm going to increase the number of customers. What's another possible vector of attack? Model of attack, mode of attack. There are two ways that you can grow an industry. There are two ways that you can increase your market share. There are two ways that you can increase value. One is you can increase the number of customers. You are already at 4 million customers. If you do this, if you sort of take it to 15 million customers and you own all of them, you would grow how much? 4x. How would you make it grow 10x? As in, this is a physical limitation of the Pakistani economy, right? You can't have, right now you don't have, you only have about, say, 10 to 15 million households. How many more households would you have in the middle class in the next 10 years? 16 million, 17 million, 18 million, 20 million, but certainly not more than 20 million. So there's a physical limitation, physical restriction on how far you can grow. So if you're restricted here and you want to grow the industry 10x, what's your best bet of growing? Remember, this is the hint, using the customer-centric model. You could explore similar market, or you could extend lifetime value, grow lifetime value. So if I want to grow the industry 10x, what is my path to get to a lifetime value of $3,000 per customer? So this is option number one. This option number one is capped. It's capped by a physical restriction in your market, in your segment. And this is option number two. And this option is not as restricted because lifetime value right now is very low. So from a disruption point of view, when you're normally trying to come in and change an industry and rework it and modify it and disrupt it, you'll find that taking a customer-centric view is a lot more simpler to explain. How many parameters are there in building a financial model? When you build a financial model, you need to look at your cost drivers, your revenue drivers, your growth drivers, your customer markets, your operational base, your HR, your utilities, your expenses. Even the simplest of models would have close to 20 to 30 different key assumptions, and then you would sort of extend them over a period of 5 years. You challenge every single one of those assumptions in your internal review. Your investors challenge those assumptions. But what you've just done now is you simplified that discussion to basically two parameters or two questions. What are the two questions? The first question is, and remember this is really important, the first question is, how do we grow this market? And not any 5, 10, 15, 20% growth. The question is, how do we grow this market 10x? So if you're taking notes, right, while I sort of walk through the framework, I want you to write down this question on a sheet of paper, and I want you to think about this as we walk through I want you to think about the fact that the segment that you work on, the space that you work on, the market that you're trying to target, how would one grow that market 10x? Not you, not your product, not your startup. If you were to grow that industry 10x, how would one grow that industry 10x? I'm saying don't think of growing using your financial model. Think of growing through your customer valuation framework. On the customer valuation framework, you have two choices. One choice is growing the number of customers in that specific space. Second is increasing the lifetime value of customers in that specific space. So if I go back to the previous slide, right, where we spoke about the life insurance industry, I have about 5 million current customers. I'm capped at 15 million customers. And the only path for me to grow that industry 10x is not through here or here, because that limits it to 4x, but here, growing the LTV. If I can grow the LTV 10x, then the industry all of a sudden would be worth how much? 10 million customers times $3,000 in LTV is worth about $3 billion. You've suddenly grown the valuation from 300 million to $3 billion. And I think this trajectory is the groundwork that you have to do before you get to the model, because from an investor perspective, I'm not as interested in how you've built your model, not interested in what your model says. I'm really interested in your journey, your path, your thinking behind the model. What do you want to do? I want to grow the industry 10x. Okay, that's great. How? What's the trajectory? What's the path? Is that path credible? Is that path believable? Is that path realistic? How does that path react to challenges, constraints, limitations, boundaries in that specific part?